And when you already have very high US equity valuations compared to foreign markets, I think that starts to look heavy at those levels. Basically, it needs more and more capital inflows just to maintain kind of the rate you got to, um, and kind of keep it going up with low volatility the way it has been, right? So I think it's that around the margins is where it matters. Generally, when we see periods where the dollar becomes overbought on the weekly chart and then rolls over into negative momentum, it's not a perfect signal, but I think it's one to watch because generally when that happens, more often than not, that has tended to resulted in a pretty significant and longer duration kind of more often than not it's a decline in the dollar relative to other currencies. Sometimes the dollar still stays heavy. I mean, it still stays strong, but maybe it stops going up at the same speed that it has been before, so it can kind of slow down. And so I think that's something to watch going forward. We have to watch the price signals because we can do all the fundamental analysis, we can put the pieces together, but we have to start seeing if price confirms it because that starts to point to are there variables that we're missing? Is it starting to go the way we expect, or do we have to go back and reassess? So I'm not like calling a super high conviction statement that the dollar's going down now, but I've observed a couple patterns here. I think that a lot of the dollars have been bid because people are piling into the U.S. growth markets. And so I think that if that starts to unwind, or at least if it stops accelerating the way it has been, I think that could start putting pressure on the dollar. A lot of confirming indicators suggest that we're maybe not in a strong phase for U.S. equity indices. Now the funny thing is, I mean, you could still actually have a positive year or a positive 2 years. But I would say that even if that happens, you'd probably, I don't think we're going to get the growth that we had over the past 2 years, right? So I don't think it's going to be a straight line up. You could eke out a positive year, but I think it would be a weaker year. Now, or you could have a negative year, you could have a very negative year, you could have a flat year, but overall, I don't really love the risk reward ratio for US equity indices, over the next 12 to 18 months. Given that inflation's at headline CPI is at like 7%, I think when we're talking how many quarter point rate hikes we're talking about, that's obviously important for some types of some areas of the market. But overall, I think it's the increase in the balance sheet that in some ways matters more than the rate hikes, especially when we're talking that smaller of rate hike. And given how high debt levels are, they're somewhat constrained from raising rates too much too quickly. I think they can raise rates, but can they quote unquote normalize rates? Not anytime soon, I don't think. And so I think that at least for asset valuations as a whole, the central bank balance sheet size is more informative. As important as monetary stimulus was for markets, another thing was that a lot of retail investors were getting stimulus checks and then piling them into the market, and I think that's behind us now. So I'm intermediate term neutral on Bitcoin. Long term, I'm still bullish fundamentally. And the way I would characterize that is, basically in this kind of you know, period of where the Fed is trying to pull back the punch, but where there's less stimulus, where money supply is growing slower than it was, now than it was over the past couple years. That is somewhat of a headwind for Bitcoin, especially because NYDIG put out a good chart the other day showing that, from 2011 to 2019, Bitcoin didn't have very strong equity, positive equity correlation. Sometimes it was positively correlated, sometimes it was negatively correlated. It was kind of so small that it was its own thing. Now it tends to like higher liquidity environments, but overall there wasn't very strong correlation. Ever since 2020, it's had very positive correlation, and I think partially that's because institutions became a big part of the market, and two, because with so much stimulus, almost everything was correlated positively. So anything other than like say cash and gold, most things went up a lot, over the past couple years. And so I think going forward, I think these correlations are somewhat heavy on Bitcoin. But I think that, when you have something that is fundamentally better than something else, eventually that correlation breaks down. It holds up better than weaker things when it's having a rough time, and that sets up the foundation for another run, I think, when the macro conditions improve. We see over this time that, during the 2020 period and going into 2022, a lot. So there's not a lot of new demand for Bitcoin. That's basically what's been taken off the market by the lack of stimulus. That the new demand coming in is not as high as it was back in 2020 and then the very early phase of 2021. However, the supply side is interesting because a lot of the weak hands have sold out. A lot of the coins have shifted more towards the illiquid strong hands that have a low propensity to sell. And so a lot of indicators suggest that basically whenever demand does come back into the market, it's kind of like a cold spring. And so that's how I'd phrase it overall, that the conditions are good, but it needs a spark. And so I don't see a spark, anywhere super close right now. So that's why I'm kind of neutral in the intermediate term. I'm just kind of watching the market for catalysts. But I think longer term is still very attractive.